Hello everyone, welcome to the third tutorial of Invbots investment competition summer 2021. This is Wallace again, nice meeting all of you. We will take around 15-20 minutes to go through the hot topic of the market right now, which is like risk management. And today, me, myself, and also two colleagues like Bosco and David will share with you our view about how to manage risk. Obviously, it's a very hot topic, but like 2 months ago, when we think about how to, to develop the topics of the three tutorials, actually, I would say like we have think about that could be potential risk, but we never think about that is such deep risk that we have to manage. No matter what, let's kick off on the tutorial today. And I'll pass the mic to Bosco. Bosco.
Thanks, Wallace. And you may heard about the risk management in business or corporate level, but what is risk management in trading? So first of all, I would love to introduce you a basic and financial concept that is the return and risk, which refers to the trade-off that potential risk raise while simultaneously the associated risk will also increase. Therefore, in short, high return, high risk, low return, low risk. And risk management enables you to limit your store when you suffer a great loss if the stock you pick it underperform or your setup is not optimized, or even the market is undergoing the high volatility, especially during the bearish market, or maybe some one-time or black swan events such as the trade war tension, pandemic, or internal policy may make the financial market more volatile. So risk management is very essential. And to me, rules are one of the crucial elements of the risk management. You may perhaps determine every details like target level, stop price level, or size, position, exposure, percentage of your portfolio before you enter in every single trade. So with the rules, you could react promptly and accurately without emotional influence, and you know what you are doing and how you will respond to the certain scenarios. Therefore, you may stick to the rules and minimize the risks. So next. And from the mathematical aspect, every time you lose, you have to gain more to cover the loss. And if you lose perhaps negative 5%, you may gain other similarly 5% to cover your loss. But however, what if you lose half of your portfolio? You have to double the amounts to cover your loss. So risk management and help us to preserve capital, because sometimes one bad trade could make you lose all your capital. Even the best traders and over the road may fail 15 to 14% of the time. So if you have low capital, you could do nothing. So that's why the risk management is very essential to every trader. And in the following, we will go through some approach that you could do to optimize your portfolio. So let's invite Ross to talk about the market condition.
Thank you, Bosco. So, well, the first question you have to ask yourself in order to manage risk is, are we in a bull and bear market? Obviously, this is the chart that we have created last Friday. And this actually, we have been telling internally, it's actually a kind of like correction or even a bear market in Hong Kong market. So this is a chart we are measuring the market breadth, and the percentage is the 20 MA percentage, meaning like the percentage of Hong Kong listed companies staying above 20 days moving average. We haven't put this kind of like the code onto our web yet, but we have been managing it and using one of the key metrics that to help us to invest throughout the market. So anyway, the quick answer on this from this chart is actually we believe that even last Friday, Hong Kong is actually in the bear market. So, wow, unfortunately we are spot on. But like the case in US market, when we are using the same sort of chart, it seems like market in US is under a correction, but not a real bear market. As you can see, um, the 20 days moving average, yes, it's like swinging between ups and downs. Um, but then there's still a quite good rebound, and some of the stock, like 50% around, is still staying above 20 days moving average. So we can talk about it later on when we go into any kind of like market section maybe. But then from our perspective, it's actually very important for us to understand the market condition in order to derive the appropriate risk management strategies. Okay, so from that perspective, we always say outperformers always possible to perform. So when we have the like the case of BYD, we're actually changing from underperformance to outperform. So like this case in the last 1 month and last 6 months, BYD underperformed like the last 5 days, which we did like last Friday, is actually outperformed. So we always have to understand the market conditions and always have to identify any potential outperformers in the market. And here is the rationale. During a bear market, like right now in Hong Kong market, not necessarily in rest of the market, winning ratio of the market will decrease, or like today is extremely low. Okay, what you have to do is, like in the case of Hong Kong and even like in China market, you have to keep only high conviction stocks. That will be only a very small portions in the market. And if you have a large number of stock in your portfolio, very likely you are incurring higher downside risk. Okay, what you have to do is, besides keeping only high conviction stock only, is you have to reduce the number of stock in your portfolio. That kind of like, for sure, you're learning a lot of academic theory, like what we do, but at the same time, from a practitioner perspective, you think about how much time you have to manage your portfolio, okay, and manage to review the fundamentals as well as the market, the stock price volatility. When you have more stock in your portfolio, you need to spend more time to manage the stock volatility during the down market, like what happened today. At the same time, when you have a lot of stock in the portfolio, you reduce the time spent on each stock. More stock you hold, high execution risk. Okay, I'm not advising you to sell everything at all, but at the same time is, when you're thinking about the rest of the portfolio, try to keep it very high conviction idea, likely some stocks that you have done a lot of work. At the same time, you manage the number of stocks, and only keep stocks that you have very high confidence. Maybe you sell some and buy some, but ultimately, number of stocks have to be reduced. That's our best advice. So at the same time, why outperformance are inevitable? One, there are always some dividend paying stock. And likely or not, their dividend paying policy and their earnings are potentially sustainable. That means when the share price declines further, the dividend yield is getting higher. Obviously, there's a chance that you'll figure out, okay, share price keep going down, but you have to understand that this is the strongest defense of your portfolio. And on the other hand, outperformers normally will have stronger fundamentals, and potentially upcoming events, corporate actions may maintain the relatively, not necessarily saying strong, but more resilient price performance. Think about it. Like tomorrow, when some stocks saying, I wanted to buy back my shares price, I have a share buyback program at whatever kind of, amount, I think that particular share price will rebound immediately. There are a lot of what we call the market neutral funds in the market. They will short some of the stocks, like today, whatever kind of stock are super underperforming now. But when we say they're market neutral fund, they have to buy something when they short. So they have to buy less underperforming stock while they are shorting super underperforming stocks. There's always some buying potential to push some stocks share price to go up. When some fund holding abundance of cash on hand, they always have some willingness to buy some stocks with potential upside after selling those underperforming stocks. Needless to say, the market is absolutely risky, but high risk, high return. There's something you have learned from day one when you enter the market and learning arriving on the finance cost. Okay? Keep your mind clear and always think about where to short, where to buy. So some typical strategies in the down market, this more real like the key list of actions you have to bear in mind. One, always keep cash level. When you're holding less stocks, obviously your cash level will increase. Why? Because wherever they're buying opportunities, you have cash immediately you can buy without selling shares at a deep low price. What you have to do is now switching from a daily price chart into 5 minutes or even 1 minute price chart. When there's sharp rebound, the chart will tell you. We are not necessarily a chartist, but we have to identify the potential deep bottom and could be rebound in a very sharp manner in just like 20 minutes potentially. Because you have to understand that a lot of funds now have a lot of cash. Second, sector rotation. In such a highly volatile market, you always have to identify the leading stock in each sector. When those stocks suddenly not declining and even potentially outperforming, you know what's going to happen. Third, diversify among different kind of market. And we will talk about it in the next chart. Finally, diversify into different assets. We are a sort of equity competition, but you also have a chance to buy, to explore investment opportunities in some asset classes like bonds, gold, silver, and bitcoins. And we'll talk about it later on. First of all, global equity indexes. If you look at the simple correlation that we generate from Bloomberg, and you can see that SPX have relatively low correlation with HSI. Obviously, not necessarily every day is very low. Some days they will have very low correlation like yesterday. I'm not too sure about today. You have to bear in mind, this is all academic type of calculations, but in general, throughout the year, HSI doesn't mean they have a very super high correlation with APEX, but at the same time, SPX doesn't have high correlation with market like Australia and Saudi Arabia. So from that perspective, when the Hong Kong market decline, you can still like diversify your portfolio into some other market. Say for example, there's an ETF called KSA, which is the Saudi Arabia MSCI Saudi Arabia Equity Index listed in US. Maybe this is a good diversification potential for you. But I mean, ultimately, you have to manage the portfolio and monitor it in a very closely manner when we have a super high price volatility. But this in general, this is true throughout the year. It doesn't mean all stock market have to go down at the same time. And this is the equity index trend in the last 6 months. It seems like the S&P in the blue line, and we have the topics, the Japan index slightly underperforming, whereas you can see the Saudi Arabia is actually performing quite well. And obviously CSI 300, the index in China, seems underperforming quite a bit. And finally, we tried to talk about the asset class diversifications, and you can explore not only in the equity markets, but at the same time, you can try to explore ETF portals or holding non-equity assets. Say, for example, TLT, which is the assets, which is the bond ETF holding 20 years plus um, treasury, U.S. Treasury bond, and is actually, well, it's kind of ups and downs, have been coming down, and it's kind of rebounding quite a bit recently. Whereas SPX, which is a deep blue line, have been going up, which is not bad. Bitcoin, you know quite well, maybe more than I do, has a nice rebound recently. Does it mean investors are trying to be risk averse? Then we also have to look at the gold. GLD is the stock code for the gold, the largest gold ETF, also a bit ups and downs. So not necessarily all the asset class would decline at the same time. When you figure out perhaps like Hong Kong and China stock market is coming down, maybe you can diversify into US market, and you're getting worried about the US market risk. Would you think about some asset classes different from equity? That could be another way for you to diversify and keep winning in the investment competition. Anyway, that could be the end of my part. I will pass it on to David. Thank you. And Bosco.
Thanks, Was. And I believe some of you may research on the telecos, like doing some analysis and through chart. And here are a few common teleco practice you can control the risk in the trading world. So first of all, it is supporting and resistance level. And what you could do is identifying the previous supporting or the resistance level and add as the stop loss level. So take May 29 as an example, assuming you may get into the long position and I'm sorry. Yeah, assuming you get into the long position in the an orange bolster consolidation zone, and then are waiting for the potential breakout. And when the price stand below the supporting, and I will take the lowest level of the consolidation zone as the supporting level. So when the price and drops below the supporting level, you have to close the position no matter what, because some investor may and trick it as a sell signal. And the second indicator is the moving average. And you could use the moving average as the stop loss level and close the position when the price touch the moving average line. And if you have higher risk tolerance, you could choose a longer duration of the moving average. And sometimes it may provide you a high return, like an Apple during the rebound in Q2. If you take and moving average of and lie there as the stop loss level, it returns you just 5.3% return. But if you choose the moving average of 20-day as the stop loss, you could earn around 14% more. So another alternative, you could choose EMA or WMA as the stop loss level. Another indicator is the channel breakout. You may do the pre and analysis to identify a trend or downtrend channels. And when there is the channel breakout, you should close your position no matter what, because and just like before, some investor perceive the breakout point as the sell signal. And other techniques is to determine the risk to reward ratio. And you have, before entering every single trade, you could determine how much you would give out as a trade-off for the potential return. And typically, at least 1 to 2 is reasonable, or 1 to 5 is more favorable. So you may say, "Oh, I know nothing about the teleco." Then you could choose the mathematical approach and just you determine how much percentage you could tolerate for every single trade. And for referring to the table, we suggest -7% or 10% should be your maximum loss for every single trade. And here is some order placing and techniques. For example, if you're using interactive broker or Futu or other professional broker, you may choose the order type like stop loss, and that is enable you to close the position at the market price if the price reach your level, or you could choose stop loss limits, or trailing stop loss is you could just determine how many percentage or the amount you could tolerate for every single trade. So next, David will illustrate more example and our advice to you.
Thank you, Bosco. Okay, so I'm going to give you some advice on some different situations. First, I'm going to talk about how to react to some earnings. Like recent earnings have delivered that, like TSMC, Intel, they all have a gap down after earnings. So what would you do after the gap down earnings? My suggestion is to reduce at least half of the positions at a market opens, because like you have to understand why it's gap down first, because usually when there is a gap down after earnings, you should usually imply a result worse than expected, or the guidance is actually worse than expected as well. So it could do some like short term, like 1 to 2 weeks, like short pressures to the price. That's why you have to be very careful about it. And then like in this case in TSMC, like it goes down. If you would like to wait until the gap is being filled, I think you have to wait for quite a long time. And then the maximum drawdown is actually quite large when you're waiting the gap to be filled, or even the gap could not be filled. Yeah. And then next night, we'll assuming you actually have a short position in Likey, like and then after earnings you gap up like 13 or something. Yeah. And then if you do not react to this earning result by actually cutting some of your positions or set a stop loss, you may actually face a huge drawdown, or even your short position could almost kill your portfolio as well. Yeah. So you have to set stop loss for each of the trade, then it won't happen. Yeah. And then the next line would be how to react to some policy, like very system. Using recent example like the 9901, which is educational stocks, and it is dropped this 40% on a single day because of some policy changes. So my advice here, if you do have a stop loss for each of your position, you won't have to wait until the loss of 40% to sell. You would have sold the stock like a 10% loss, and then the followings won't create any damage to your portfolio anymore. So always set a stop loss. And then the second one is to understand how will the policy affect your company. So understand the deep down reason behind, and then you will see that that's very significant. Yeah. And then the next slide would be like how to react to some technical sell signals. By using example of 1696, it has actually have a gravestone doji pattern. This is a technical sell signals of the 10 candlestick patterns. It actually implies a bearish reversal is actually coming. So my advice here is to at least cut half the position, or you actually take your profit first, half of it, and then you set the stop loss for another half to actually lock down your profit or to stop loss. Yeah, and then that's how it goes recently after the technical sell signal has appeared. Yeah, and then another example would be in this next slide. Yeah, using 981 as an example, 1 to 2 years ago, it's actually appeared a large bearish candlestick on an uptrend. How would I identify this candlestick pattern? Is like it opened near the highest, and then it closed near the lowest, and the body is actually longer than 3 previous trading days. And then once it appeared, I think this that's an alert to you. I think I would cut most of the positions in most of the time. Yeah, and then also TME actually appear one of that kind of bearish candlestick also. So with stop loss, you actually you can you can avoid those losses, and even if you don't, you still have to sell it after it. You someone would like to wait for a rebound, but as you see, after that candlestick have appeared, it's no longer up above that level again. Yeah. And in the last line should be the end. Yeah, that's the end of my part.